Thinking about investing in stocks but don't know where to start? You're not alone. Investing can seem intimidating, but it's more accessible than ever, and it's one of the best ways to build long-term wealth. You don't need a finance degree or a ton of money to get started. The real secret? Stick to a few simple principles. Be patient and have a plan. In this video, I'll show you exactly how to start investing, step by step with zero jargon. Let's jump in. Before we get to the how, let's talk about what a stock actually is. Stocks are one of the most common ways people invest and build wealth, but the concept can seem mysterious if you're new to it. At its core, a stock represents ownership in a company. When you own a stock, you own a piece of that business, no matter how small. Imagine a company as a giant pizza. The whole pizza is the entire business, with all its assets, employees, and ideas. When you buy a stock, you're buying a tiny slice of that pizza. You become a part owner. The more slices you own, the bigger your share of the company. If the company does well, maybe it sells more products, expands to new markets, or invents something amazing, your slice becomes more valuable. The price of your stock can go up, and your investment grows. If it pays dividends, you get a little extra as a reward. Dividends are like a thank you from the company, sharing some of its profits with you, the owner. But if the company struggles, maybe sales drop or it faces tough competition, your slice can shrink in value. The price of your stock can fall, and your investment might be worth less than you paid. Stocks go up and down, and that's normal. The market is always moving, reacting to news, trends, and the economy. The key is remembering you're investing in real businesses, not just numbers on a screen. Behind every stock is a company with people working hard to succeed. When the company grows, so does your investment. As the business expands, hires more people, and earns more money, your share can become more valuable. When it stumbles, your investment can drop. Sometimes even good companies face setbacks, and that can affect your stock's value. That's the risk and the opportunity of investing. The ups and downs are part of the journey, and over time, patient investors can be rewarded. Understanding this is the foundation for everything else. Once you grasp what a stock truly represents, you're ready to explore how to choose, buy, and manage your investments wisely. Ready to buy your first slice? You'll need a brokerage account. Think of it like a bank account, but for stocks and ETFs. Opening one is easy. Just pick a reputable app like Fidelity, Schwab, or Robinhood and sign up. You'll provide some basic info, link your bank account, and transfer in whatever amount you're comfortable with. Even $20 is enough to start. No suits, no high fees, just a few taps on your phone. Once your account is funded, you're ready to invest. That's your ticket to the stock market. Now, which stocks should you buy? Start with what you know, companies you use and trust, like Apple, Amazon, or Google. These are called blue-chip stocks, big established businesses with a history of success. Focus on companies with strong fundamentals and long-term potential. Avoid hype and penny stocks. Those are risky and closer to gambling than investing. Make a short list of 5 to 10 major companies you understand. Pick 1 or 2 to start. Remember, you're becoming a part owner in real businesses, not chasing quick wins. The goal is steady, reliable growth over time. Keep it simple and stick to quality. That's how you build a solid foundation. Next, don't put all your eggs in one basket. Diversify. This classic saying is especially true when it comes to investing. Imagine if you put all your savings into just one company, hoping it will always perform well. If that company stumbles, your entire investment could take a big hit. That's a risk you don't want to take. If you only own Apple and something goes wrong, your whole investment suffers. Even the biggest, most successful companies can face unexpected challenges, regulations, competition, or sudden market shifts. Relying on a single stock is like walking a tightrope without a safety net. Instead, spread your money across different companies and industries. By owning a mix of stocks from technology, healthcare, energy, and more, you protect yourself from the ups and downs of any one sector. This way, if one area struggles, others can help balance things out. The easiest way to achieve this balance? Buy an ETF, like one that tracks the S&P 500. ETFs are investment funds that hold shares in many different companies, all bundled together. With a single purchase, you instantly own tiny pieces of hundreds of top companies. This means your money is working in many places at once, not just tied to the fate of one business. This is called instant diversification. and it helps smooth out the ups and downs. When one stock drops, others may rise, keeping your overall portfolio steadier and less stressful to watch. You don't have to pick every winner, just bet on the market as a whole. By investing broadly, you're giving yourself the best chance to benefit from overall growth, without needing to predict which company will come out on top. Whether you buy a few individual stocks or an ETF, make sure you're diversified. Review your portfolio regularly to ensure you're not too concentrated in one area and adjust as needed. It's the smartest way to reduce risk and grow your money over time. Diversification helps you weather market storms and take advantage of long-term opportunities. Diversification is non-negotiable for long-term success. It's a foundational principle that every smart investor follows, no matter their experience level. So, start with it from day one, and you'll set yourself up for a safer, more rewarding investment journey. The most important mindset for building wealth? Think long-term. It's easy to get caught up in the excitement of quick wins or the fear of sudden losses, but true success in investing comes from patience and a forward-looking perspective. The stock market isn't a get-rich-quick scheme, it's a get-rich-slowly machine. Over time, the market rewards those who stay the course, not those who try to time every peak and valley. Don't obsess over daily price changes or panic when things dip. The market will always have ups and downs, but reacting emotionally to every swing can hurt your long-term results. The real power comes from compounding, letting your returns earn more returns over years. Just like a tree grows from a tiny seed into something strong and enduring, your investments can flourish if you give them time. Invest with the intention to hold for at least 5 years, ideally much longer. The longer you stay invested, the more you benefit from the market's natural growth and recovery cycles. Make investing a habit. Set aside a little money every week or month and invest it automatically. Consistency is key, and automation helps you stick to your plan even when life gets busy or the headlines get scary. This is called dollar-cost averaging, and it takes the emotion out of investing. By investing regularly, you buy more shares when prices are low and fewer when prices are high, smoothing out the impact of market volatility. Sometimes you'll buy high, sometimes low, but over time, it averages out. This steady approach helps you avoid the stress of trying to predict the perfect moment to invest. Ignore the noise, stay consistent, and let time do the heavy lifting. The headlines may scream panic, but your calm, steady approach is what builds real wealth. The market will have bad years, but history shows it always recovers. Every crash has eventually been followed by a recovery, rewarding those who didn't give up. Your job is to keep investing, reinvest dividends, and be patient. Reinvesting dividends accelerates your growth, turning small gains into bigger ones over time. Think in decades, not days. Patience is your superpower. The longer you stay invested, the more you harness the true magic of the market, steady, compounding growth that can transform your financial future. That's it. You now know how to start investing the smart way. Don't get stuck in research mode forever. The best time to start is now. Start small, learn as you go, and let your money work for you. Building wealth is a marathon, not a sprint. You've got the tools and the knowledge. Now take action. Thanks for watching. Drop your questions in the comments and don't forget to like and subscribe for more investing tips.